Welcome back to Simple Mind Space, your go-to podcast for mastering your money and your mind. Today, we're diving deep into the thrilling world of finance and unpacking the latest jobs report that has the market buzzing. Now, if you've been following along with us, you know the market loves a good surprise. And sometimes that surprise comes in the form of a jobs report that throws everyone for a loop. That's exactly what happened recently, and the aftershocks are still being felt in the bond market. See, after the Federal Reserve went bold and slashed interest rates by a hefty 50 basis points, everyone thought they had it all figured out. The economy seemed to be cooling down, inflation appeared to be finally retreating, and a collective sigh of relief swept through the financial world. But then, bam, the jobs report dropped, and it painted a very different picture. This wasn't your run-of-the-mill jobs report, folks. This report showed the economy wasn't just holding steady, it was actually gaining momentum. We're talking strong growth in key sectors like healthcare, travel, and leisure, all pointing towards a consumer that was alive and kicking. Now, this unexpected surge in hiring threw a wrench in everyone's carefully laid plans, especially the Fed's. You see, the Fed makes its decisions based on the data it has at hand, and this data suggested they might have acted prematurely with that supersized rate cut. Think about it this way. When the Fed lowers interest rates, it's like giving the economy a shot of espresso. It encourages people to borrow money, invest in businesses, and generally keep the wheels of commerce turning. But too much espresso can make you jittery and lead to some unwanted side effects. And in the case of the economy, that side effect is inflation. So, here we have the Fed trying to delicately balance supporting economic growth with keeping inflation in check. They took a calculated risk with that 50 basis point cut, and now they're left to deal with the consequences. The big question on everyone's minds now is, what happens next? Will the Fed continue to cut rates aggressively, or will they adopt a more cautious approach? Well, the answer, as always, depends on the data. The upcoming inflation numbers will be crucial in determining the Fed's next move. If inflation shows signs of picking up again, the Fed's hands might be tied, and we could see a pause in rate cuts. On the other hand, if inflation continues to cool, it could give the Fed more room to maneuver. But here's the thing about the market. It hates uncertainty. And right now, uncertainty is the name of the game. No one knows for sure what the future holds, and that's making investors a little skittish. We're seeing this uncertainty reflected in the bond market, which is essentially the market for loans issued by governments and corporations. Bond yields, which are a measure of the return investors expect on these loans, have been fluctuating wildly as traders try to make sense of the mixed signals. The bond market is like the economy's mood ring. When things are looking rosy, bond yields tend to rise as investors demand a higher return for lending out their money. But when storm clouds gather on the horizon, bond yields fall as investors seek the safety of these investments. Right now, the bond market is sending mixed signals. On the one hand, long-term bond yields have been falling, suggesting that investors are worried about the long-term health of the economy. On the other hand, short-term bond yields have been rising, indicating that investors expect the Fed to keep interest rates higher in the near term to combat inflation. This disconnect between short-term and long-term bond yields is what we call a flattening yield curve. And historically, a flattening yield curve has been a pretty reliable predictor of an economic slowdown. Now, I'm not saying we're headed for a recession. Not at all. The economy is still strong, and there are plenty of reasons to be optimistic, but it's important to be aware of the risks out there and to make sure your portfolio is positioned accordingly. So what does all this mean for you, the savvy investor? Well, first and foremost, it means you need to stay informed. Keep your finger on the pulse of the market and pay attention to the data. Don't just rely on headlines or gut feelings. Make sure you're getting your information from reliable sources. Second, it's more important than ever to have a diversified portfolio. Don't put all your eggs in one basket. Instead, spread your investments across different asset classes, such as stocks, bonds, and real estate. This will help mitigate your risk and protect your portfolio from any sudden market swings. And finally, don't be afraid to seek professional advice. If you're feeling overwhelmed or unsure about how to navigate this uncertain market environment, reach out to a financial advisor. They can help you develop a personalized investment plan that aligns with your goals and risk tolerance. The world of finance is always changing, but by staying informed, staying diversified, and staying calm, you can weather any storm and come out ahead. Remember, knowledge is power. And there you have it, folks, a crash course in the current state of the markets and what it means for your money. I hope you found this episode helpful and informative. If you enjoyed this deep dive into the financial world, don't forget to hit that like button, subscribe to the channel, and share it with your fellow finance enthusiasts. And as always, keep those simple mind space principles in mind. Think clearly, act decisively, and build the future you deserve.